Let's break down day trading and see what makes it so unique in the world of finance. At its core, day trading means buying and selling stocks or other financial assets within the same trading day, never holding positions overnight. Every trade is opened and closed before the market shuts. The main goal? To profit from tiny, rapid price changes that happen throughout the day. These small moves can add up quickly if you know what you're doing. Think of it like a digital flea market, except instead of antiques or collectibles, you're trading stocks. You buy a stock, hope it ticks up in value, and then sell it just minutes or hours later, sometimes even seconds. Unlike long-term investing, which is about patience and believing in a company's future, day trading is all about quick decisions and fast moves. It's not about holding on for years, sometimes not even for a full hour. Day traders might make dozens or even hundreds of trades in a single day, skimming small profits from each one. Over time, these small wins can really add up, if you're disciplined. It's high speed, high stakes, and requires constant attention to every tick of the market. There's no room for distraction. You're not investing for the long haul. You're actively betting on short-term price swings, trying to outsmart the market in real time. Success demands discipline, a solid strategy, and a clear understanding of the risks involved. Without a plan, losses can pile up fast. It's not for the faint of heart. The pressure can be intense, and emotions can run high. Next, let's see how day trading actually works in practice and what it takes to get started. Let's break down how day trading really works, using a simple example anyone can follow. Imagine you decide to buy 100 shares of a company called Coffee Corp at $10 each. That's a $1,000 investment, all in just a few clicks. Minutes later, the price jumps to $10.15 per share. You quickly sell all your shares, locking in a $15 profit in almost no time at all. The goal is to repeat this process over and over throughout the day, making small profits that can add up. But here's the catch. If the price drops instead of rising, you could lose money just as quickly as you made it. That's why experienced traders use stop-loss orders. These are automatic sell instructions that help limit how much you can lose on a single trade. Day trading depends on volatility, stocks that move up and down a lot in a short time. Many traders also use leverage or borrowed money to try to boost their gains. But remember, leverage is a double-edged sword. It can make your wins bigger, but it can also make your losses much worse. That $50 win could turn into a $60 win if you're using leverage, or just as easily, a $60 loss if things go the wrong way. Every second matters in day trading. Prices can change in the blink of an eye, and every trade you make carries real risk. It's a high-stakes game that demands speed, precision, and nerves of steel to succeed. But the risks? They're huge, and many traders lose money. Let's talk about what makes day trading so risky.
Day trading is risky, really risky. You can lose your entire account in a single afternoon, especially if you use leverage. Sometimes you can even end up owing money to your broker. The stress is intense. Your money can swing wildly in seconds. Emotional decisions, panic selling, or greedy holding lead to big losses. Fees and commissions eat into every trade, making it even harder to profit, and you're up against pros with better tech, more money, and years of experience. Most retail traders are outmatched from the start. It's not a level playing field. So, is getting rich quick even possible?
The dream of fast riches draws people in, but the reality is harsh. Over 90% of day traders lose money, most within months. Stock prices are unpredictable in the short term. Luck can fool you into overconfidence. Even a good strategy loses often, and big losses wipe out small wins. The system is stacked. Market makers and brokers profit from your trades, win or lose. The people selling you courses? They're making money off you, not from trading. It's an uphill battle, and the odds are against you. Consistent profits are rare. Most get-rich-quick stories are just that, stories. If you're still interested, you need a survival plan. Here's how not to lose everything.
Still want to try your hand at trading?
Here's how to protect yourself and avoid the most common mistakes that wipe out beginners. Only use money you can afford to lose. Treat it like the cost of a night out or a hobby, not as a way to pay your bills or make a living. Start small, with a few $100s at most. This way, you can learn the ropes without risking your financial security or peace of mind. Educate yourself. Read books, watch videos, and learn about risk management. Make sure you understand how stop-loss orders work and why they're essential for every trade. Never risk more than 1% of your account on a single trade. This rule helps you survive losing streaks and keeps your emotions in check. Practice with a paper trading account before risking real money. Simulators let you test your strategies and build confidence without any financial risk. If you can't make fake money, don't trade real money. Use your practice results as honest feedback and don't rush the process. Focus on 1 or 2 stocks and stick to one simple strategy at first. Mastery comes from repetition and learning from your mistakes. Keep your expectations realistic. Survival is the first goal, not instant riches. Set achievable targets and celebrate small wins along the way. Protect your capital above all else. Remember, profit comes second. Your main job is to stay in the game. Be careful, be patient, and never stop learning. The market will always be there. So take your time and build your skills for the long run.